Picture a quiet Treasury auction. Inside a sterile government room in Washington, a small group of officials waits for the bids to arrive. No cameras, no press. Just screens displaying numbers that determine whether the United States, the world's largest economy, can pay its bills for another month. For decades, these auctions were boring, predictable, automatic. Investors lined up to lend America money. But imagine a morning, not today, not tomorrow, but someday, when demand doesn't show up, when buyers hesitate, when yield spikes, when the world suddenly questions the credit of the United States. Not because America is weak, but because its debt has grown so large that the math no longer looks real. In that moment, the entire global financial system would hold its breath. Because the US dollar isn't just national currency, it's the foundation of global trade, banking, insurance, commodities, tech, and sovereign reserves. And if the country issuing the world's reserve currency is drowning in its own debt, how does that actually end? This is the story of the trillion-dollar debt trap, how the US built it, why both political parties contributed to it, and the two radically different futures that might follow. One outcome is survivable, but the other one is not. For most of modern history, the United States has played a unique economic role. It prints the world's reserve currency, controls the world's largest bond market, and issues debt so safe that global investors treat it like oxygen. This privilege created an illusion. America can afford anything. Wars, tax cuts, stimulus, healthcare, infrastructure, bailouts. If money was needed, money was created, or borrowed. Year after year, debt accumulated quietly in the background, and because interest rates stayed low, no one worried. Debt didn't feel like a problem, it felt like fuel. But illusions eventually collide with arithmetic. Debt is not new. America has borrowed since its founding. But the modern spiral began in three distinct waves. Wave 1 was the 1980s, the era of tax cuts and deficits. Ronald Reagan slashed taxes and increased military spending. The logic was simple. Use debt to ignite growth and defeat the Soviet Union. It worked economically. Inflation fell, GDP surged, but deficits exploded. A new norm emerged. Deficits were no longer emergencies, they were policy tools. Wave 2 was the 2000s, wars, tax cuts, and the financial crisis. The early 2000s brought another round of tax cuts, followed by two major wars. Then came 2008. To prevent economic collapse, trillions were deployed through bailouts, guarantees, and stimulus. It worked. The system survived, but debt jumped once again. Wave 3 was the 2020s, from the global pandemic and the aftermath. This was different. The US printed and borrowed money at a scale never seen in peacetime. Stimulus checks, PPP loans, unemployment expansions, corporate backstops, quantitative easing. It stabilized the economy and ignited the highest inflation in 40 years. For the first time, Americans felt the cost of money printing in their everyday lives. So why does America borrow so much? Because the political incentives are aligned with it. Raising taxes is unpopular, cutting spending is unpopular, expanding benefits is popular, and lowering taxes is popular. Both parties discovered the magic trick. Borrowing lets leaders give voters what they want without appearing to pay for it. For 40 years, the easiest political decision was the most fiscally destructive, and the central tension crystallizes here. What happens when the world's safest borrower becomes the world's most indebted borrower? The U.S. national debt now exceeds $34 trillion. Interest alone will soon surpass defense spending, and within a decade, it may exceed all discretionary spending combined. But the real danger isn't the dollar amount, it's the trajectory. Debt is rising faster than GDP, faster than tax revenue, and faster than the population growth. This is not a debt pile, this is a debt curve, one bending exponentially. For the past 20 years, the US borrowed at near zero interest rates. Debt was cheap and basically free. Then inflation returned. The Federal Reserve raised rates. Suddenly, the interest bill doubled and then doubled again. America now spends more on interest than at any time in history, not because it borrowed so much last year, but because it borrowed too much for 40 years. This is the core mechanism, the compounding trap. When debt grows faster than income and interest grows faster than taxes, a nation hits a point where borrowing becomes self-perpetuating. Debt means higher interest rates, means bigger deficits, means more borrowing, means higher interest rates, means once again bigger deficits. The United States is entering this loop, and loops like this don't unwind quietly. The dollar's dominance gives America extraordinary privilege. It can borrow in its own currency. Its debt markets are the deepest in the world. Foreign governments buy U.S. debt to stabilize their economies. This created a belief inside Washington that the U.S. cannot default because the world will always lend to it. That belief is powerful and dangerous. Cutting spending angers voters, raising taxes angers voters, but borrowing? Voters don't feel that immediately. Politicians discover that they can distribute benefits today and leave the cost for future administrations. Debt became a political anesthetic. It numbed the consequences of hard choices. And with voter psychology, the public expects low taxes, high benefits, cheap healthcare, strong military, low inflation, and stable markets. But mathematically, you cannot have all 6 of those things without enormous borrowing. Americans want the lifestyle of low taxes and the service of high taxes. The result is predictable. The government spends like a European welfare state and taxes like an American one. The gap is filled with debt. Investors trust the U.S. because it has always paid its bills. But trust is not permanent. It is earned and maintained by math. If the U.S. appears unable to control its deficits, markets can reprice that risk instantly. And when the world's safest bond becomes slightly less safe, every financial asset on Earth adjusts. This is the real danger. Debt crises don't unfold slowly, they unravel all at once. So there are 2 future paths: slow correction or violent collapse. The U.S. itself once escaped a massive debt trap. At the end of World War II, federal debt was 119% of GDP. Yet within a few decades, it fell dramatically. How? Not through austerity and not through default, but through a combination of fast growth, moderate inflation, high employment, steady immigration, and financial repression, keeping interest rates below inflation. This approach worked because America was young, industrial, expanding, and dominant. Countries like Greece and Italy tried the harsh path: slash spending, raise taxes, cut pensions, and shrink deficits. It did stabilize their finances, but cratered their economies. Austerity is clean on paper, but in practice, it collapses demand and triggers political revolt. Japan avoided crisis by monetizing its debt internally. Its central bank purchased massive amounts of government bonds, interest rates were suppressed, and asset markets were supported. No crash occurred, but growth stagnated for decades. The price was time, not violence. Argentina, Turkey, Zimbabwe, these nations show the dark scenario: printing money to cover deficits, currency collapse, capital flight, hyperinflation, and default. This is the nightmare ending, a spiral so severe that trust evaporates completely. And history shows a pattern. Great powers rarely fall suddenly until the moment of confidence breaks. So the positive scenario: managed inflation and soft austerity. This path is not painless, but it's survivable. Inflation stays slightly above interest rates. This quietly erodes the real value of the dollar. But economic growth remains strong. Immigration, innovation, and technological advances keep GDP rising. Gradual spending reforms occur. No dramatic cuts, slow adjustments over decades. Defense, healthcare, and Social Security are restructured, incrementally, politically disguised, often through indexing changes. The dollar remains dominant. As long as the U.S. controls global finance, the world continues lending. The Fed absorbs more debt over time. Not dramatically, but enough to keep markets stable. This is the scenario that resembles post-World War II America or modern Japan. Debt remains high, but stability is preserved. And then there's the negative scenario, a crisis of confidence. This is the catastrophic path. It doesn't start with default, it starts with hesitation. A treasury auction goes poorly, yields spike, foreign investors pull back, Congress deadlocks on the budget, rating agencies downgrade debt, and markets panic. To stop the bleeding, the Federal Reserve prints money, a lot of money. Then the dollar tumbles, inflation accelerates, bond markets revolt, and pension funds and banks suffer massive losses. And in that scenario, the US enters a sovereign debt crisis, a phenomenon the world has never seen at this scale. Global supply chains seize, commodity markets break, foreign economies, and a recession turns severe. Luckily, this is the rarest outcome because it is the costliest. Countries that hit this scenario rarely recover their former power. The Soviet Union, the Ottoman Empire, the British Empire after World War II. Debt wasn't the only factor, but it was the accelerant. The US is not Argentina. It is not Greece. But it is also not the US of 1945. Demographics are aging, interest costs are exploding, political gridlock is worsening, and the global financial system is more fragile. And the fiscal gap is wider than at any point in American history. So which scenario happens next? Well, that depends on the confidence, and confidence depends on policy. Debt crises don't announce themselves. They accumulate slowly, and then erupt suddenly. The US has time. It has options. It has the world's most powerful economic engine. But the math is pressing closer. Soon, interest payments will exceed national defense, then Medicare, then Social Security. When interest is the largest line item in the federal budget, a nation is no longer spending money on itself. It is spending money on the past. This is the real debt trap, not the number, but the direction. America's greatest advantage is its credibility, its institutions, its stability, its innovation, and its global reach. Credibility is fragile, and it can be lost in months. And rebuilding it can take generations. The US is not destined to collapse, but it is not guaranteed to avoid crisis either. The future is a spectrum, not a certainty. The debt spiral will eventually end. All spirals do. It will end either with managed inflation or with market revolt, with gradual reform or abrupt crisis, with a soft landing or a hard crash. But the most important truth is, debt is not about money, it is about choices made by millions of people over decades, guided by the beliefs shaped by convenience, fear, ambition, and hope. And when a nation's psychology changes, its trajectory changes. The US built its debt through confidence. It will escape it, or succumb to it, the exact same way.